Thank you. And Colette, please. Colette.
External member of the Prudential Policy Committee.
Okay, thank you very much. And to Alex, please.
I'm Alex Brazier. I'm the Bank of England's Executive Director for Financial Stability and a member of the Financial Policy Committee.
Thank you. And to Dave, please.
I'm Dave Ramsden, Deputy Governor for Markets and Banking at the Bank of England and member of the MPC and the FPC.
Great, thank you very much. And finally to Gertjan, please.
My name is Jan Vliegen and I'm an external member of the Monetary Policy Committee.
Great, thank you, Jan. So the way we're going to run this is there'll be various questions from the members of the committee. Members will endeavour to identify the person or persons to whom they are directing their question. But if you feel you're not being brought in on a particular question, you have something you really wish to contribute, don't hesitate to raise your hand and I will endeavour to bring you in at that point. Alternatively, of course, you can always write to the committee at any time with your thoughts, and we're always happy to hear from you in that way. I would ask everyone on the panel, particularly as we've got 5 panelists today, it's quite a large panel, to be as brief and succinct as you can in your answers, please. I know that's sometimes difficult because there's a lot to discuss, but if you could have that in mind, I would be very grateful. The final thing to mention before we get going is that there may well be a division in the House at a little bit after 3 o'clock, we think perhaps about 10 past 3. In the event that that happens, I will suspend this committee for 15 minutes to allow members time to participate in that division if they wish to do so, and then we'll re-adjourn after 15 minutes. So just to alert you to that possibility. That division apart, we don't think there's likely to be any other interruptions to our proceedings today. So that's all said. Thank you very much and welcome to each of our panelists for joining us today. And I'd like to start by going to a question I'd like to direct to the 3 members of the MPC who are before us today, and to go back to the meeting of the MPC on the 4th of August, and in particular, a little quote that I'll read from the minutes of that meeting, which was that overall the risks to the outlook for GDP were judged to be skewed to the downside, albeit that different members placed different weights on the nature and the scale of those risks. And I just wondered whether the MPC members on the panel could just comment a little bit and explain those different weights and the kind of debate that there was around that particular point. And if I could start, please, with Andrew.
Yes, thanks. That's a very good place to start. So let me make 2 points about the fan chart to start with, and they're 2 very interesting points actually. One, what we tend to call the skew, i.e. the size of the risk, and the risk in one direction was probably, I think, one of the largest ever, i.e. the risk to the downside. The other relevant measure on the fan chart is the width of the fan chart, which is a measure of uncertainty. That is the largest measure of uncertainty that has ever been in a fan chart in the history of the MPC, which is going on for nearly 25 years now. Mm. So you can, I mean, that's a way of sort of, in a sense, describing what we're in. There was, I think I'd have to say, there was broad agreement on 2 things. One was the fact that we were in a period of very heightened uncertainty. So the debate wasn't so much really around the scale of that, or that there's a very big downside skew. As you say, it was really around sort of views on what makes up that skew, where obviously a lot of things come into play. And I'll give you my own view, really focus in the interest of brevity on 2 things. I think in the short run, very short run end of it, clearly there's a lot of uncertainty and different views around the question of how much what we call sort of natural caution enters into the behaviour of people in the economy as we go forward. We didn't make any assumptions about vaccines. We didn't make an assumption about this precise pattern of COVID going forwards, because frankly, we don't know. We did, I think many of us did feel that there will be a gradual alleviation in a sense, as we've seen. And I think good capacity to treat COVID appears to be increasing, which many congratulations to the health service. But there are different views about that, the course of that, and there are different views about how that mirrors into what I might call the exercise of natural caution as people re-engage in the economy. That's the first point. Second point of the two that I would highlight is what I think many of us call the sort of the structural point. How much structural change will there be in the economy as a consequence of the shock that has happened? And I'm sure we'll come on to this as the session goes on. I mean, how is that going to manifest itself? How are we seeing it now? And to the extent that there is structural change, it's important because that's the thing that can lead to what we tend to call scarring, i.e. longer term, if you like, dislocation of pieces of the economy. And it can lead to longer term unemployment and a raising of the natural rate of unemployment for some period of time. So those assumptions are A, critical to the economy and critical to people's lives, frankly, and B, there is a lot of uncertainty around that. So there will be, to your question, different views on exactly how that is going to unfold. To finish, we have an assumption in the forecast that's around about just over 1.5% of GDP is represented by this, what we call long-term scarring, which, to put it precisely, means if you go back to the inflation report in January, i.e. pre-COVID, and compare the outturn now with the outturn then, it's about 1.5% lower at the sort of the end point, and that's a sort of way of capturing that element. But I stress there's a lot of uncertainty, huge amount of uncertainty around this. And this structural change issue, I think, for all of us, it's going to loom large in the forecasts to come. So I'll stop there, Chair.
No, that's very helpful and succinct. Thank you. I'm going to go to Dave now. And Dave, in your response, if perhaps you could flesh out a little bit this point on scarring, in particular, which areas of the economy and which sectors is the bank particularly casting an eye over in this respect as you monitor the recovery?
Yeah, happy to contribute on this because I think it's very easy to focus on the very short term, but actually I think these longer term issues are absolutely critical in terms of assessing how the economy is going to look once the COVID shock has passed through it. From my perspective, these really are issues of judgment at present, and that's why there was a healthy debate on the committee as to the kind of channels for potential scarring. As Andrew's just said, we've only really we've allowed 1.5% of GDP as a permanent impact. So once we're the other side of the COVID shock, we think the level of GDP will be permanently about 1.5% lower. For me, all the risks are really that number will be greater than 1.5%. And if I can give you a few of the channels, but also suggest some of the adjustment that might have to take place. I mean, what we've tended to focus on in this forecast, as Andrew emphasised, was the potential impacts through the labour market, where we have allowed for some degree of mismatch in the labour market persisting. And that's because as the economy adjusts, certain sectors will be, we're already seeing that, impacted more than other sectors. And jobs will be lost in those sectors. And we think that there'll be a mismatch in terms of the skills that the people who have lost their jobs in those sectors, their ability to move into the growth sectors of the economy. So that's one area where we have made some allowance and we have revised up the medium-term path of unemployment. But in other areas, potentially, as we see the next phase of the recovery unfold, we'll be able to assess just how great this sectoral impact is on the labour market, but also we'll be able to look at the degree to which the UK economy is repurposing through this shock. There's been lots of focus, for example, on what might happen to the commercial real estate sector, for example, as it's likely that probably a semi-permanent effect, if not a permanent effect, coming out of this shock, reflecting both what we've discovered about people's abilities to work from home in many sectors, particularly in certain service sectors, but also natural caution, is that we might find that there's less demand for real estate as currently, commercial real estate in city centres, for example, as currently configured. So those, that commercial real estate will probably see less investment in the immediate future. Will that add up to a less productive or a more productive economy? That's an open question, and we didn't really draw any conclusions on that at this stage. But that's the kind of mechanism that you'd want to consider to ask yourself whether there might be more permanent scarring on productivity alongside the labour market. And then a final factor I just mentioned is capital deepening, just whether, how much investment goes into certain sectors. For example, one of the sectors where we've seen a lot of growth in employment in recent years is in retailing. Potentially, as more retailing moves online, it may be that more investment could take place in retailing in terms of capital stock than in labour. That would have obviously an impact on the labour market, one of the three channels I've identified, but it also could lead to greater productivity over time. So this is a really complex set of factors to untangle, and we and others are only really starting to scratch the surface on thinking about this. I think our estimate of a 1.5% impact of scarring is a kind of good it's a good starting point on thinking that there will be a permanent effect. But as I say, for me, the risks are more that unless the adjustment is very quick and happens quite easily, that the chances are that the scarring effects over time may be larger than that, and obviously there'll be an interaction with policies. But at the moment, we've made that assessment, but we've also highlighted that the risks are overall that the scarring impact could be greater than a shortfall of GDP of 1.5%. I'll stop there, Chair.
No, Dave, thank you very much. That's very helpful. I just want to come to Jan, a little bit tight on time now for my section, so fairly short answer if you can. But could you just pick up on this productivity point? Because I think, having looked through the minutes of the meeting, the point was made that on the one hand, you may have a move from labour-intensive sectors, which may help drive up productivity, but equally a lack of capital investment that may be a drag on productivity. And it seems to me that, as Dave was suggesting there, it's not clear which way that might break. Do you have a view on what you think might be going on with productivity as we come through the recovery?
So I think that tension between those two forces of productivity lost from people having to reallocate to sectors that they are less expert in, but potentially productivity gained if they move to sectors that have a higher productivity. That's exactly the tension. The thing that I wanted to emphasize is very briefly, which is a slightly different focus, which is I think it's not a good idea as monetary policy setters to focus too much on the supply side of the economy in isolation, as if you can think of that separate from the rest of the economy. And so what I mean by that is if we're considering scenarios where the economy needs to undergo much more structural change, meaning that potentially the unemployment rate is going to be elevated for a much longer period of time, that's also an economy where demand is going to be weaker, and therefore an economy that's going to need more monetary and fiscal stimulus in order to close spare capacity and get back to running at full capacity. And so where my focus is slightly different from the previous discussion is that I think the risks are on the downside in terms of the output gap and the evolution of the output gap. So in the current forecast, as a central case, we have that most of the output gap is closed in about a year and a half's time. I think that's quite quick, and I think the idea that with the current setting of monetary and fiscal policy that we move into excess demand in the second half of the forecast period is rather less likely.
And thank you very much. I'd like now to go to Harriet, please.
Thank you very much, Chair. And I'm going to ask about inflation. So again, mainly for the members of the Monetary Policy Committee, perhaps starting again with Dr. Vlieger, just asking what are the market signals, particularly the price of gold, telling you about inflation expectations at the moment?
So just a couple of things about gold. First of all, it's a terrible idea to look at the nominal price of gold because it is a nominal price and therefore it's expected to go up over time. And you would expect it even if the gold price was very stable, you'd expect it to set a new record every month. So the fact that it's at all-time highs tells you precisely nothing. A better idea is to look at the real price of gold, which is elevated but not at record highs. But then if you look at previous episodes where the gold price was very elevated, you realize very quickly that gold is a terrible predictor of inflation. Because the previous times when gold was not quite, a little bit higher than where it is now, but at historical peaks was in the early 1980s, which was the beginning of a long decline in inflation. And it was in 2011, which was also the beginning of a long period of weak inflation. So gold is a terrible predictor. We don't look at it very much as an indicator of inflation. We spend much more time looking at both surveys and financial market measures of inflation expectations. And what you see there is that in the immediate aftermath of the economic damage from the coronavirus, all these expectations went down, and given all the fiscal and monetary stimulus since then, we've just about been able to bring them back to pre-pandemic levels. They are not elevated at all, they are in line with the target, and they have been rising from depressed levels, and they are now at more comfortable levels where we think it's consistent with the target.
Thank you. And for Sir Dave, I noticed that in the most recent charts on inflation expectations, that they also are extremely wide in terms of the possible ranges, and the deflationary risks have gone up slightly since the January chart. Do you think deflation is a bigger risk than inflation at the moment, Sir Dave?
We certainly, in the August monetary policy report, we recognised that there was a downward skew on inflation as well as on GDP. For me, I think it's also worth saying though, but because there is this interaction between supply and demand effects that Jan was just highlighting, I think the inflation fan and the downward skew is probably not as great as it is for GDP. So yes, I think the disinflationary risks have gone up compared to January. But I would also put some emphasis on the supply side factors that might mean that there is less spare capacity than you would otherwise think, given the fall in demand and in headline GDP that we've seen. And as Jan has just highlighted, financial market expectations, but also the survey indicators that we review of households and business inflation expectations, certainly for the UK, suggests that inflation expectations, despite this shock, have recovered and appear reasonably well anchored, which I think for us as the Monetary Policy Committee can give us some comfort, but you obviously have to be very vigilant when you've had a shock like this and when the skew is to the downside, because you want to avoid a situation where weaker inflation expectations become entrenched. For me, I'm comfortable with where inflation expectations are at the moment, but I was still voting back in June and then again in August to continue with stimulus, consistent with the forecast that showed inflation coming back to target by the end of the forecast horizon, and finishing very marginally above target at 2.2% in the final year.
Thank you. And then for the governor overall, in terms of where we are in monetary policy, if monetary policy were a car, would you say that your brakes are able to work better than your accelerator?
That's an interesting question. Well, we certainly had to put the accelerator down very hard in March and onwards, as you know. And I use the phrase in the remarks I made at Jackson, or not at Jackson Hole, on Friday of go big and go fast. So that may have a certain driving analogy, not sort of driving any of us should do, obviously. But so in that sense, I mean, we use policy very aggressively. Now, the thing I'd say is in August, and I emphasised this point on Friday, is that in August we also did, I mean, we've done a further round of quantitative easing, another £100 billion, which is going to continue in terms of its execution through to around the end of the year. But the other point we made in August is very important because we also did something of a pivot in terms of the use of the policy tools towards forward guidance. And this is very important because what we said in August in the guidance was that we were going to require more than what you might call normal evidence and assurance that the economy really is on track to meet the projection that Dave and Jan have described in the central case. I think this, that really goes straight to the point that Jan made about the risk to the downside and the output gap. So we were very, very deliberate in August in using forward guidance. And if you like, it's a different pedal. Stretch the analogy to breaking point now. But an important one at this point to give a clear signal that because of the uncertainty, because of the risks, we're going to need more than normal evidence and assurance that the economy is on track and therefore inflation is on track to return to target before we act.
Can I just ask a bit further on that, though, where the economy has returned, and for example, hairdressers have put up their prices by 5%, potentially theatres might have to charge more because you have to sit more distantly. There does seem to be some evidence of the sectors that are returning, raising prices. How does the Monetary Policy Committee look at that, Governor? Is it seen as a one-off, or is it seen as something that could lead to more sustained inflation?
Well, I think a couple of things there. You're right that we are seeing obviously evidence of certain activities where the costs of conducting the activity have gone up, and there is commensurate reflection in pricing. Now, interestingly, and this may be on the same point, I was going to make the point that since the August report, so about a month we've had now since the August report, I would say that the most likely short-run path of inflation is higher than we had it in the report. Now, that may be partly for the reasons you're giving, but probably more, but this may be part of the same story, that we made an assumption in the report, particularly about the pass-through of the VAT cuts. This will be a short-run effect. I think the evidence, particularly from our regional agents that we've had since then, is probably the pass-through is weaker than we assumed it would be a month ago. So that will tend to cause short-run inflation to be slightly higher than we thought it would be. And it probably won't now go negative, I think, is our best guess. We thought it would very briefly go negative through a combination of VAT and also the way in which the Eat Out to Help Out scheme was accounted for in inflation. VAT pass-through looks a bit weaker. That may be for the reason you give, that people are absorbing increased costs by not passing on in that way. Fuel prices, oil prices, a bit higher than we thought they would be. They've gone up a bit more. Now, the second really key point is, of course, is a very traditional point, which you rightly say. How will we look at that as a monetary policy committee? Well, those are what we tend to call first-round effects. What, of course, we're very interested in looking at is, do they pass through to second-round effects? And that's where, to go back to what Jan and David said, that's where inflation expectations are critical. I just finish on that. I mean, so far, and particularly in market pricing, UK inflation expectations have been pretty stable, actually, for all of this, which is interesting, given, obviously, the amount of volatility we've had going on during the course of this year.
Thank you very much, Governor. I think my time is up.
Great. Thank you, Harriet. I'm going to go now to Angela, please.
Thank you, Chair. I want to spend a little bit of time on the labour market, because obviously we're approaching a very important juncture with the beginning of the winding down of the furlough scheme. And the Bank of England's work and its forecast was basically saying that you expect a material rise in unemployment, and you're expecting it to double from 3.9 to 7.5%, with average earnings going down. Do you think there's anything that you should be doing as a bank to encourage this rise in unemployment not to be as high? Something specific?
Well, I'll start. Let me be clear. Of course, none of us actually wants to see a rise in unemployment of that nature. So we should use all our tools to, to do all we can to prevent that happening. I mean, what we're seeing now is that there's been quite a sharp reduction in the use of the furlough scheme already. I think at one point about 30% of private sector employees were on it. It's now down to about 13%, 14, but it's sort of flattening out. The other thing I would say is, and I think this is one of the interesting points, is that actually it's, I mean, unsurprisingly, but it's becoming much more concentrated in terms of the sectors of the economy that are using it. So it's gone from being quite a general phenomenon to quite a more activity concentrated. So if you look at something like arts and entertainment, for instance, quite a high proportion of people who work in that sector are furloughed still. Now, I think that has two effects, I think, in terms of policies, and by the way, they're not really for us, I should say. One is that I think it does support calling into question, what is the right way to support the economy going forward, as we've switched from a sort of more generalised labour market issue to a more focused issue. And secondly, going back to really what we were talking about earlier in terms of the question of structural change and the question of to what extent we will see not only unemployment going up, as if we see people shifting, as Jan was saying, people shifting from activities, having to go into activities that they're initially at least less well trained and qualified to do, how much longer term unemployment we'll see. History would suggest we will see it at that point, and that's what lies behind quite a bit of our assumption that we will get an increase in unemployment. By the way, I should say that number of 7.5% was of course about 2% lower than we had in the simulation that we used in the scenarios that we used in May. But I think the question then is to what extent will we see this structural change, and to what extent are the policies, not really monetary policy, I should say, which obviously can be used to help to alleviate and shorten the impact of that.
I mean, Governor, in the BBC interview in August, you backed the Chancellor's decision to unwind the furlough scheme. Why were you supportive of the unwinding, and why did you make that support public in the way that you did? Well, especially given that other countries aren't actually ending their support.
I think let me say this, for the reason that I just gave, I think it's got to the point where a scheme that was designed very sensibly for a general labour market feature, which was 30% of the population, not being able to work, has now changed. I mean, the labour market's changed, the nature of COVID has changed. It's much more specific now in terms of the effects it's having. And therefore, the reason, I said it in August, and I would still support it, and I'm not going to put words into anybody's mouth as to what should be done, because these are government issues. But I think that change in the nature of the issue requires a sort of change in the nature of thinking about what the right policies are to address it.
If there's as you rightly point out, focusing down of the problems to very specific areas, and obviously you've mentioned entertainment and leisure, culture, doesn't that argue for a similar focusing of furlough to make it more sector specific and ensure that particularly those places that really simply are still closed or can't really operate, say theatres, which used to rely on 90% ticket sales to break even and now have a much reduced capacity, doesn't that argue for much more focused support for the areas that through no fault of their own have been affected by the aftermath of the coronavirus challenge?
You know what I'm saying? I think that's a very important and interesting question, but it's really outside the bank's remit. So I think it's right to say that the nature of the question, the challenge has changed. I don't think, honestly, that's one within the Bank of England's remit.
And also, in your speech, you were talking about the hit to the economy not being as high as you'd expected it to be in May, which is obviously good news, and I hope you're correct rather than the OBR. But also the assumptions underlying that were that there'd be no big second wave of the virus and that there would be a free trade deal with the EU sort of in place without too much bother at the end of the year. Neither of those things are necessarily very likely to happen as we, or at least they're mired in uncertainty, aren't they?
Well, let me say two things on that. I mean, that goes back to the first question that the chair asked, which is why have we got such a big downside skew on the forecast? And there's a lot of things that can be in that skew. One is that we have, unfortunately, a quite sort of, large-scale, repeated series of local restrictions in the context of COVID. We're not making any predictions on what those would be. We're merely saying that skew can accommodate quite a lot of that, as it were. If you look at the width of the skew on the forecast, I mean, it is a very big number in GDP terms. So that is within the sort of the scope of the risks we see. Second thing on trade and the question of the EU. I mean, let me be clear on what's in the forecast, first of all. The central case, we always condition our central case on government policy. It's conditioned, therefore, on a CETA-style trade agreement. The downside skew has in it, again, you can put quite a lot of things into the downside skew because you can have combinations of things. It would certainly accommodate a WTO-style outcome. What I would say is that as we now build up and will build up to the early November monetary policy report, the next one, I expect that we will not only focus on those things, but also the key question in consensus is how much disruption or not might there be to trade and therefore to the economy at the turn of the year, and we will certainly be focusing on that. But I will once again reiterate that downside skew has a lot of scope for a lot of things in it.
And Dr. Verlingen, you said in your evidence to us that there's at some stage jobs do need to move, but you were, I think, reading what you were saying, you were worried about how long it might take, given the extent of the structural change that COVID-19 might have initiated in the economy. You were worried that it would take longer for the economy to return to a trend similar to that we were expecting prior to the emergence of this disease. Could you say a bit about how worried you are that recovery will take much longer and what pressure it may be putting on our economic recovery, and whether you think that trying to pursue much faster structural change using policy would help that rather than hinder it?
Right. So the point I was trying to make is that if you start from the rather, I think, optimistic scenario, turns out that we were thinking about at the beginning of the year, where we thought, okay, hopefully the virus is a relatively short-lived thing. It disrupts certain types of economic activity a lot, other types of economic activity rather less. And so what you get is you get some spare capacity opening up in certain sectors of the economy. And as concerns about the virus fade away, the people who have been furloughed or have lost their jobs in those sectors can be rehired in those sectors. And that's a process that in principle can happen very quickly. Of course, the easiest version of that is if you take a restaurant as an example, they have furloughed some workers, and at some point the restaurant reopens and they take their furloughed workers back. That's sort of an instant adjustment. It gets more difficult if, for example, those workers need to find work in a different restaurant. Rather than the one that they were originally furloughed from. It gets even more difficult if it turns out that, for example, the economy has permanently lower demand for restaurant seats, and therefore some people that used to work in the restaurant sector need to move to a different sector. And then you get into a scenario where, rather than having this relatively rapid labor market recovery, the labor market recovery probably starts to look more like it did in previous recessions. And just to put some numbers on that, for example, the average across the last 3 recessions were that in the first 5 years of the recovery, the unemployment rate fell by about 0.8 per year on average. Now in our forecast, we have it over the next 3 years falling by 1.2 per year. So that's faster than the historical average. I think it's reasonable as a baseline because, as I said, some reintegration of furloughed workers is, you can expect that to be a fairly rapid process, but to the extent that there are some people left at the end of that who cannot go back to their original job, for that part of the labor force, I would expect more traditional labor market dynamics, which means that it takes much longer for the unemployment rate to decline because these people need to retrain, look at different sectors, possibly even move to different parts of the country depending on what the circumstances are, and that takes much longer, is much more difficult. That's the point I was trying to make.
Thank you, Chair.
Thanks, Angela. I'm going to Felicity now, please.
Thank you, Chair. And can I first say, great to see you all, and thank you for taking the time. My questions are on consumption and household saving. Let me start with the Governor, and then I will bring in Alex and Colette, because I'm conscious that you haven't yet talked. We've clearly seen some good data on consumption over the course of the last few days. Retail sales data for July was positive. We've seen very good housing data today, both in terms of prices and activity. How much comfort do you take from this? And is there a risk that all we're seeing here is delayed expenditure and it could peter out quite quickly?
Well, as we said in the report and we said earlier, the collective view of the committee was very cautious in the sense that although we've seen a very pronounced and rapid recovery, this is the sort of I don't like using letters to describe this, so I'm going to go to use the letter B once. We're very cautious and have taken the view that we should not read anything literal into what is going to happen next as a result of what has happened. But you're right that household spending, in fact, is now close to its pre-pandemic levels, in fact. But it is a pretty uneven picture. And it's uneven in a number of respects. It's uneven in terms of its makeup across different parts of consumption. As you said, we've seen a very rapid recovery of the housing market. The numbers that came out this morning on mortgage approvals, very strong. We've actually, throughout much of the period, what we tend to call delayables spending, which is things that people have a choice over when they do, home improvement spending and so on, has been strong. But obviously, what we tend to call social spending, of the sort of the eat-out type, went through a period of great weakness and still hasn't recovered strongly. So, very uneven picture. We've also seen structural change already in spending. I mean, I think one of the things that, one of the most interesting facts I can give you, I think, is on retail sales. So if you look at retail sales in July, it was actually, I think the level was about 1.4% higher than July of last year. And total retail sales in a month, they're around about £37 billion. Actually within that, the share of online retail sales had increased from about 20% earlier in the year before the pandemic to nearly it's under 30%. And that basically means in a month about a £3 billion switch in retail sales to online selling. Now, this really is, sorry for sort of load of facts, but this really underlines the points that Jan has been making about how much we're going to see, persistent, more structural changes as a result of this. How much that is then going to break in the sense of car brakes, sorry, the path of consumption from here on. Our forecast suggests that after the third quarter, the rate of recovery will slow naturally. Of course, it has to go away. We can't go on recovering at that rate. And then I'll just reinforce what Jan has been saying. Then, of course, the question is, over what speed, if we are going to see structural change, will this process go forward, and with what cost in terms of consumption output? But you're right. I mean, so far, actually, the recovery of consumption and household spending has been very fast. By the way, of course, that is to some degree, but not completely, offset by a very weak story on investment.
Yes. And are you concerned about the regional disparities? I'm pretty focused on London, representing a central London constituency, and clearly footfall is very low in London, property activity very low in London. Does that concern you, given the fact that London has been the driver of growth previously?
Well, I mean, it's certainly an issue in terms of the point I made about unevenness. So, I mean, one of the most interesting series that we look at a lot of very fast real-time indicators at the moment, and it's interesting when you look at the geographical distribution of credit card spending. The weakest area is London. And this is probably for two reasons, I guess. One is obviously the question of return to work, and the other is the question of foreign tourism, I think. But you're right. I mean, there is an impact there, and again, it will have an impact. And the unknown question, and sort of come back to the point that Jan made so rightly, is then how that plays out in terms of the more structural change in the economy.
Yes, and you also mentioned the move from high street retail to online retail. Are you concerned about the implications for employment with that move?
Well, I think we just fit that back into the story that we've sort of in a sense raised a number of times already this afternoon about how much that is going to cause what I might call a sort of structural change and a structural break in some areas of employment, and to what extent that's going to cause longer term unemployment as people look for new jobs, retrain. So that's the point Jan made.
Yes, thank you. Let me bring in Alex now. On household savings, we've clearly seen a substantial increase in household savings, especially in affluent families. Are you concerned that this potentially delays the recovery?
Well, I'd make 2 points on that. The first is a lot of that saving has been, in some sense, forced. People have still been earning their income, but they haven't been able to spend because of the public health measures. So to some extent, it's not really a sort of economic choice. It's a feature of the events people have, or the circumstances people have found themselves in. But of course, in line with the earlier discussion about downside risks to the outlook more generally, these are all things that could explain some of the downside risks that Andrew and Dave and Jan were talking about. And so when it comes to the financial system, we haven't for a moment hoped for the best. We have been planning and stress testing the system to much worse outcomes than is contained in the central case in the monetary policy report. And maybe we'll come on later to talk about those stress tests. But the central element here, and this I think is crucial for household saving and borrowing, is that because the banking system in particular is much more resilient than it was back in 2007, 2008, it isn't in a position where a downturn in the economy has forced it to rein in and tighten credit conditions and hold back from lending to households and businesses. So had we been in the position we were in 2008 with our banking system, we would now be in a full-blown banking crisis. As it is, we're a million miles from that. And credit conditions have tightened a bit in the mortgage market. They've tightened a bit in corporate debt markets as well. But they haven't tightened any more than you would expect given the sort of economic uncertainty. And as a result, household lending has got going again. Mortgage approvals are back where they were a year ago. Corporate lending has obviously been very strong, and maybe we'll talk about that later. But we haven't seen that retrenchment of credit supply. And as a result, households won't be forced to save to try and pay down their debts. And that's a big, big difference to where we were back in 2008 in the last recession.
Thank you. And you mentioned that the banking system has coped very well with people working at home. What do you think lies behind the reluctance of a lot of the big financial institutions to get workers back physically into the city?
Well, I think we've seen economic activity get going again. We've seen activity in the financial sector in particular continue largely through this. But I think there are two factors holding people back. And by the way, this isn't just a London phenomenon. You see this in lots of cities. The first is that people have a caution about the public health issues. I feel safe coming to work, but I can quite understand why many people might not. Public transport capacity is a related factor there. And the other is that, of course, with COVID-safe guidelines, it's not possible to use office space, particularly in central London and dense places like that, with the intensity that we used to use it. So it's actually not possible to bring lots of people back very suddenly. And while lots of us may want to come back, because I think one of the things I've certainly learned from this is that there are merits to working in an office when it comes to efficiency and collaboration and creativity, for example. But because of those constraints, I don't think we can expect to see a sudden and sharp return of lots of people to very dense office environments that we were used to. We should expect a more phased return, depending on the public health outcomes that we see over the coming weeks and months.
Thank you. And let me bring in Colette now. We've talked about household savings going up. Do you think that this could become a permanent feature of our economy? And are you concerned that, given the fact it is more affluent families who are saving more, that we could have more entrenched wealth disparities going forward?
Felicity, just before I respond to that, I'd like to add something to what Alex just said about people returning to work. And Alex, you didn't touch on the question of children returning to schools. And that is, of course, a major issue for a great many parents. They have to feel that their children are being properly cared for, that their children's education is being taken care of. So I would just like to add that point, Felicity, to the number of issues that Alex mentioned about returning to work. You know, we all have rather different views about this. I don't know whether it's obvious to you, for example, but 4 of your 5 witnesses this afternoon are speaking to you from the Bank of England. So, you know, we are, as it happens, back in the centre of London, but not everybody feels like that. Now, the question you wanted me to talk about was savings behaviour. What can I add to what's been said? I think the important point that Andrew wanted to emphasise to us was that it's hard for us to be clear at the moment how far the trends we're seeing are persistent. Alex also made the point that quite a lot of this saving is in effect sort of forced saving. People have not spent on the things they would normally spend on. So I think, Felicity, the main point I would make to your very interesting one about distribution is it's a little bit early to call that. Plainly, it's almost a sort of arithmetic point that, you know, better off families had saved in this pandemic. But I would be very, very cautious about moving from that to drawing inferences about inequality of wealth distribution. I think.
Colette, I am so sorry to interrupt you, not least because you make a very valuable contribution. It's your first contribution. We have actually had the division bell sound, I believe.
Oh, no.
There is now a division in the House of Commons, so I'm going to, we will come straight back to you when we reassemble, which will be in 15 minutes. So I'm going to suspend the committee now for 15 minutes. Order.
Okay.
Order.
See you in 15.
Do please all stay online. Don't log off. Thank you.
much, Chair. I think I was in the middle of making, it's very kind of you to say it was a good point, but it was actually a rather boring point, I think, which is that it's a bit too early to tell what the distributional impact of this episode will be. We're obviously, as Andrew and colleagues have said, observing interesting things like savings behaviour. We're observing very interesting and for many people distressing labour market developments. But the longer term implications of this for inequalities, it's a bit early to call. If I may, Chair, I would like at this moment to alert the committee to the fact that the very distinguished British Nobel laureate, Sir Angus Deaton, is leading a major project on inequality in the United Kingdom, which is going to start reporting from February of next year. And I think that could well be the moment when we will start to see some hard facts on the impact on inequality.
Thank you. I am now finished with my questions.
Right, that leads us to the interesting situation, because I don't think that Steve is back with us yet. So I wonder whether I might go to Rushana on trade and international growth. Rushana, would that be okay?
Hi.
Thank you.
Hi there. Yeah, that's absolutely fine. Well, good afternoon, everyone. I wanted to focus a bit more on some of the things that Angela raised. One in particular around the emerging challenge that we need to return to, which is around Brexit. So starting with the governor, can you say to us where you think things are at in terms of the range of outcomes for the economy and how the forecasts would differ, including in the circumstances in which there's not a free trade agreement, and what that would mean. And if you could just talk us through what the worst case scenario would be, where if we had no deal and a second wave, what does that mean for the economy, and what interventions could the bank be making to try and reduce the even greater challenges on top of what we already have? You're on mute still.
Sorry, Andrew, you're on mute. Yeah.
Is that better?
Yes.
Fine, sorry about that. I think delete while we were at. So I won't go back over what I said earlier, except to say that I think the key question, which you rightly point to in what you said, is it's not so much what trade agreement is reached, it's how much disruption goes with it. And obviously the weaker the trade agreement to no trade agreement, the question obviously is back, does that lead to more disruption? And as I said, that's a question we will be coming back to in November, not least because one of the important questions for us, well, two important questions. One, has COVID had an effect, first effect, in the sense that surveys that we had last autumn on this question, I think suggested that about 60% of firms in this country felt they were reasonably well prepared. Question mark, what is COVID? What is the disruption caused by COVID done to that measure of preparedness, and then the scope for disruption? So that's one question we'll be coming back to. I think the second question here, and here it gets, I'm afraid, pretty complicated, of course, is, you rightly pose what if we have a big return of COVID, and we have some trade disruption at the same time. Now, the problem, the reason I say it gets complicated, here's the problem. Both of those things disrupt trade. And you can't disrupt trade twice, as it were. So unpicking those two is complicated. We started that, addressing that question sort of in the August report in thinking about the fan chart. And we have got, as I said earlier, a very big, downside skew on the fan chart. So you've got a lot of stuff that can unfortunately, go wrong in that space. I would say that based on the work we did in August, the downside risk, the short-term downside risk from COVID is much bigger. The disruption that COVID can cause to the economy is much bigger in the modelling we did in August. Longer term, of course, hugely dependent on, do we get, as I mentioned earlier, the sort of gradual amelioration of the sort of the impact of COVID without assuming any sort of vaccine breakthrough. You might think that the longer term, the relativity shift, that it takes longer for the economy to adjust to trade disruption through disruption around the trade agreements, and the COVID effect might come off a bit more quickly, but that's a judgment. The last part of your question, I was going to, you rightly asked the question, what will the Bank of England do? Well, I hope I can give you assurance on that from both by what we did in March and by what I said on Friday in the virtual Jackson Hole session, where I made the point that it's very important that our policy framework is robust enough so that we can act, as I said, we can go big and go fast if we need to. Because obviously, if we see the sort of conditions that you were talking about, then you would expect, and we would expect, frankly, a sizable reaction from the banking and the monetary policy.
So, Governor, could you just elaborate on what that might look like? And also, I appreciate what you're saying about. Well, I appreciate what you're saying about COVID risks being greater in the short term, but you haven't. I want to push you a bit further to give us a sense, because the public will be looking at this and wanting to get a sense of what that combined threat looks like for us as a nation, and what government needs to do, as well as what you will do in the bank and others will do.
Well, okay, so the fan chart in August has, as I said, I mean, broadly, we had three international issues in mind. One was obviously COVID, both domestically and internationally. Second was the question of, how's the trade agreement with the EU going to come out? The third one is the one we haven't mentioned yet, which is broader, what I might call geopolitical tension, US, China, whatever. All those three things are out there. Now, I should say, when we draw up fan charts, we don't precisely calibrate these things. That's a hazardous business. But again, the fact that we've got a fan chart, which I think I'm right in saying, if you measure it at certain points, I mean, the edge of the fan chart has a GDP level which is somewhere like 12 to 14% lower than what it is at the moment. Will give you a sense of the scale of the things that can go on in that. The interactions are very complicated because, as I say, all of those things could lead to a reduction in trade. And that is, we're going to do more work on that, and we're going to do more work on the state of preparedness. Hopefully, we can get a better read on that as the economy comes out of the COVID shock in the next.
Okay, so just a final question for you. Okay. So just a final question on you, just picking up the point about big and fast. If we say we end up with the worst case scenario and a doomsday scenario, and of course none of us want that, what does big and fast look like through the lens of your role in the Bank of England?
Yeah, of course. So, I mean, look, can I make 3 points about our toolkit? We've done a lot of work on the toolkit. That part of that work was summarised in the Jackson Hole speech I made, and actually in the very big paper that we issued on Friday. So first of all, I did make the point that there's a lot of debate about how quantitative easing actually works. I mean, Ben Bernanke famously said it works in practice, but not in theory. We advanced with some caution the argument in that paper, based on evidence, that particularly in situations of market dislocation, and that may well have sort of economic dislocation behind it that we had in March, and that you're talking about in what may come, it seems to have a bigger effect. So it's a tool that is somewhat state contingent. So that's an important lesson to draw about how we use that toolkit. As I said earlier on, we've also pivoted to use forward guidance. And thirdly, we've made quite clear that we've done work on negative rates actually since the last Treasury Select Committee hearing we had, where I set out what we would do. We think that it is a tool that it's in the box of tools. We're not planning it at the moment. We've got no plan to use it imminently, but it is in the box. If it was the right thing to do in response to the situation you've just described, if it was a better approach than the other tools, then it would, the case for bringing it out of the box would be strong.
Right. So that's really helpful. Thank you. Would anyone else like to come in on any of those points from the panel?
I mean, it goes back to hearings we had in that prehistoric age before COVID. I remember you talked to Mark Carney about this, and you talked to me about it, I think, at my appointments hearing. And I think both Mark and I were talking about sort of how we calibrated headroom in monetary policy at that time. I made the point in the Jackson Hole remarks quite really. We've done a load of work and obviously, been through a very big situation. And frankly, I think, looking back, as I said in the Jackson Hole remarks, hindsight is a brilliant thing when you have it. We probably underestimated the headroom we've got, that we now think we've got, because we've done a huge amount of work to think our way through a problem.
Right, thank you. So Dave, you had your hand up.
Yeah, thanks. Just to really reinforce what Andrew was just saying, in terms of the disruption that might come with a disorderly WTO or other deal, so where there was disruption at the ports and such, there's obviously a limit to what we can do by going big and fast. But if there was any sign that a combination of COVID and whatever happens on Brexit, or indeed any other shocks, and Andrew alluded to geopolitical shocks, and also other shocks can always come along. I think what we've been trying to stress in recent weeks, I did an interview for the Times back in August, Andrew did his speech last Friday, is that we can step up the pace of QE significantly. We've slowed the pace to 4.5 billion or so a week. Back in March, when we were going big and fast, we were doing 13 billion of purchases a week, by far the fastest ever. And that had the effect of dealing with the financial market disruption, which otherwise could have had an impact on the real economy and affected lending. So I just wanted to reinforce that short-term point. And then on the long term, as Andrew was suggesting, Brexit, the deal that we get will come more to the fore in terms of its long-term impact. All the analysis that the Treasury, that the Government Economic Service has done for the government, the independence of analysts have done, suggests that the impact of changes in trading relationships really come through in the long term. They build up incrementally, and that's where, for example, you would see more significant differences between a free trade agreement of the kind that we've assumed in our central case, but also if we fell back on orderly WTO terms, what that might mean. Those would have much longer term impacts, but equally they might also be offset by a repositioning of our trading arrangements, because obviously you have to take account of new trade deals that could be done through us not being part of the EU.
Sorry, Roshanara, you're muted, I think.
Sorry, it happened automatically. Just to wrap up this. Yeah. Okay, just so you could envisage a situation in a worst case scenario with a second wave and no deal Brexit, that QE could be significantly higher than what has gone on before per week.
Certainly high. In August, let me just give you the timeline. Back in March, we were doing 13.5 billion of purchases, 13 billion or so a week. We slowed that to just under 7 billion back in June, July, and then we slowed it again to 4.5 billion in August. We both have in order, as Andrew was saying earlier, to complete the current programme by the end of the year. We have headroom to do materially more QE if we need to add to it, and also we have the operational
and other capabilities to do it fast if market dysfunction required that. So we can influence both the size and the pace.
Thank you. Thank you very much.
Great, thank you, Roshanara. Can I go to Julie now, please?
Thank you, Chair. Yes, thank you. Can I start with the Governor, Andrew, please? We've talked about household consumption. Could you give me, paint us a picture of what you've seen in business investment, please?
Yes, well, as I alluded to, I think, before the break, it is weak by comparison. And the evidence we have from our agents and from surveys that we do, the so-called decision makers panel, is that that hasn't changed much. So the messages firms are giving us on investment is that, you know, their investment intentions remain weak. Now, I mean, sadly, I'm afraid, I don't find that surprising in one sense, because we know from history and from economic theory that there is a strong relationship between the level of uncertainty faced by firms and uncertainty in the economic outlook and the impact on investment. And I therefore think it's unsurprising, given, as we've said earlier, and we've calibrated in the Monetary Policy Report fan chart, a record level of uncertainty for the last 25 years, that therefore that is having a negative effect on investments, and that it will be quite some time before that is, I suspect, sort of, that is unwound. Obviously, the other point I'd make is that, again, the point we were making earlier, that given the uneven impact of that, one might also expect quite uneven patterns of investment going forward. So some sectors, obviously, I mean, if you're going back to my point about online retailing, I mean, if you've got such an expansion in online retailing, it's not necessarily surprising that you'll see an investment in sectors like that. So you may see quite an uneven pattern of investment as well.
Could I ask you for a little bit more? That's an interesting, when you talk about uneven patterns. Could you, expand a little bit on some of the other sectors that may either, invest more or have a more positive outlook in terms of investment, and those that might have a less confident outlook?
Well, I mean, I can only sort of, in a sense, relate it back to those sectors that appear to be recovering more rapidly. So I made the point about sort of delayable consumption being actually quite strong, really, from quite early on in the period of restrictions. And then that translating through into, as things got lifted, some sectors of the economy where, again, purchases, as far as the housing market, obviously, we're seeing currently strong activity. But again, I think there will be uncertainty in the housing market as to what extent that's a bringing forward of activity through the stamp duty issue, and also a sort of an unblocking of a pipeline that was there before that got blocked during the restrictions. We've seen quite strong activity in car sales, see that. But also, as I said, in delayable areas like home improvements. I mean, those are the things that seem to be active, and certainly, when we talk to people in the economy, our agents talk to people in the economy. I mean, sadly, obviously, if you're in areas of the economy, again, like arts and entertainment, some areas of retailing, restaurants, you're probably not going to be thinking about investment at the moment.
Would anyone else like to add anything on that subject? Perhaps I could move on then to debt. Obviously, we laud and praise, I think very rightly, the success of many of the Chancellor's schemes in terms of providing debt support to those companies to get us through this crisis. To what extent, Andrew, is that going to be a longer-term problem in terms of particularly smaller companies perhaps struggling to pay that off before they even get to the point where they might think about investing? Oh, you're on mute again, Andrew, sorry.
Apologies. Oh, no, sorry. I think it is true that, of course, there are going to be many companies who are going to come through this with higher levels of debt than they expected. For some, that will be a matter of... Some, however, will not find that so much of an issue, not least because actually the level of cash deposits by companies in the banking system has been high. And they may find that they have certainly cash balances. And actually, interestingly, the level of cash balances by the corporate sector has gone up during a period of restriction. So some of this we find may be precautionary borrowing, precautionary use of the schemes, which people will then pay down quite quickly because they've got through it, as it were. I think for some, but this is probably for the medium to large end, I think we may have discussed this before, I think there is a genuine question in my mind about to what extent the market will need to enable equity provision. Otherwise, we will have some elements of the corporate sector that will be over-indebted. And I should say, make an FPC point here, we were worried about over-indebtedness and leverage in some parts of the corporate sector prior to COVID. So I think there is a question about equity finance. That's something I'm keen that the markets and the financial market enables the provision of equity. I'm actually pleased that equity provision has been available for some firms during this shock, notwithstanding the severity of it. And for others, I think yes, there is going to have to be quite a delicate workout process to get debt levels back down to their level. And I know this is again is something that I think both the banks and government are very focused on. And going back, I would say this, wouldn't I? Some of the sort of painful discussions I've had with the committee in my previous life. It is absolutely critical at this point to avoid some of the problems we've had in the past, that there is a clear, what I might call, understanding of the rules of engagement for working through this, between borrowers, lenders, and I think with government involvement as well. Now, I know that process is underway. It's critical because what we don't want is a repeat of some of the things that the really unfortunate and difficult things that we've seen from the past.
Thank you. Does anyone else like to widen it out, if possible? Does anyone else have anything to add to what Andrew said? So Dave, perhaps, or I was wondering whether there are actually zombie companies out there that we either know about or we don't know who they might be, that will have a profound effect on certain sectors or on the economy in general. So Dave, perhaps.
There's been an ongoing debate actually for the last, after the last financial crisis, as to whether there were lots of zombie companies being supported. And and most of the analysis suggests that for example, what led to the weakness of productivity growth after the last crisis was that it was a much broader range of factors. I think this time round, we really need to distinguish between the interventions that were absolutely necessary to bridge the UK through an extraordinary recessionary period where we saw growth plummeting, day by day, week by week, month by month through March and into April. And then the kind of recovery phases since. To really reinforce what Andrew was just saying, yes, some companies will now have taken on more debt, but that was absolutely necessary to bridge them through that period. Not all of them, will be viable going forward. And that's why, as we enter the next phase of the recovery, we do need to, in terms of the kind of interventions, as Andrew was saying, I think we move away from thinking about economy-wide measures and more, to measures that might be more targeted. And we've seen the government already doing that, with the Eat Out to Help Out scheme and other interventions. Equally, in that phase, as we move for large and small companies, as we move away from the initial recovery phase, trying to emphasize the importance of equity alongside debt. And that's where, back to what Andrew and I and others have been saying about the working of the financial markets, because financial markets are orderly at present, because financial conditions are supportive, companies are able to raise equity. And that's very different again relative to, say, the global financial crisis, where financial markets were in turmoil for much longer. So we do need to be sort of recognizing the conditions, as we see them in each stage of the recovery, and then working, across the authorities, but particularly looking to, private equity markets here to actually, to carry on. Also, to be looking at fund managers in, the investment management industry. There are ideas around how they might be able to, create new funds that would encourage investment. So there's a whole range of approaches needed. But unfortunately, there will be an adjustment where some companies will go under, and others, will have taken on too much debt. And, it won't be given the kind of shock we've had, it won't be a situation where every business can work through this.
Thank you very much, Chair. My time's up. Thank you.
Thank you, Julie. And going now to Siobhan, please. You just need to unmute, Siobhan, I think.
Hey, sorry. I just want to look at the issues of mortgages. I'm particularly concerned about first-time buyers being squeezed out of accessing mortgages due to high interest rates and large deposits required. I am sorry about this. I've just lost my page with my questions. Okay. Right. Gosh, I am sorry about this. I had it all ready.
That's all right. Would you? I see that Colette would like to come in. So why don't we go to Colette?
Okay, thank you.
I'll give you a moment just to get your papers together.
Yeah, thanks, Chair. Thanks. Just while Siobhan's putting her notes together, Chair, I wanted to just add a thought to what Dave Ramsden was saying about equity finance a few moments ago. It's quite a big area of focus for the FPC in the next bit of time. And the important question for us is going to be small and medium-sized businesses, equity finance. Is it available? And do they want it? And that is going to be an important area of focus for us. And I make the point about do they want it, because many people sitting around the committee table will know that entrepreneurial small business people don't always want other people coming in and taking equity in their businesses, but that might be just what their business needs. So we need to have a rather important national conversation about this. It's a very, very long-running issue for this country, and the FPC would like to make a bit of progress on this going forward. Thank you.
Thank you. That's helpful. Lorna, are you?
Yes. No, I'm fine now. Thank you.
Brilliant. Thank you.
Yeah. We've had quite extensive reports that due to the stamp duty reduction, mortgage brokers have been swamped with demands from borrowers, and that they're unable to keep up with it. As a result, they're increasing interest rates, particularly to first-time buyers. Are you concerned that the base rate the cut in the base rate has not been passed on to sections of the mortgage market? And I'd like to ask Dr. Jan to answer that.
So I think one of the things that we have seen, and I think this is what you're referring to, is there's been a widening in the gap between the interest rate that's charged on a 75% LTV mortgage, so a mortgage for which you have a very high deposit, relative to the interest rate that's charged on a mortgage for which you have a much lower deposit. Now, to some extent, that gap had narrowed over the last few years and has just gone back to levels that prevailed a few years ago. It's true that means that in terms of the stimulus from lower interest rates, it is not there's not as much stimulus as would have been the case if all these mortgage rates had fallen by the same amount. But it's also important to point out that a mortgage with a much lower deposit is a much riskier loan for a bank to make. And so it is right that there should be a higher interest rate attached to it. And it's not really for us to say how much higher relative to interest rates with a higher deposit. And the economic circumstances have changed very drastically over the last few months. There is now the prospect of a significant rise in unemployment, which previously wasn't there, which also makes these products riskier. And so you would expect some adjustment in the risk price. And I'll draw the analogy also with what's happening with lending, not just by banks, but by financial markets to the corporate sector, where you've seen a widening of the gap in the interest rate that's charged to highly leveraged companies relative to the interest rate that is charged to companies that are less leveraged. And there's also something that is entirely what you would expect when the economy weakens and prospects become both worse and riskier, that there should be an adjustment in these loan rates.
Except that when you deal with a housing market, you deal with a basic need of people to have somewhere to live. And if the group of people we're actually squeezing out of the system are first-time buyers in favour of buy-to-let landlords, does that not have a wider social consequence that you should be minded to consider?
There might indeed be social priorities that people would attach to who you want to own houses, but that is absolutely not a monetary policy issue. If you think that certain sections of the population should get subsidies so that they can afford to live in their own house, even though the market price doesn't allow them to do that, then that's a matter for government. That's not a matter for the central bank.
I would argue, though, that the market in terms of housing is pretty broken anyway, certainly in London and the southeast.
Can I just, Andrew had his hand up.
Okay, sorry.
I just wanted to add one brief point to underline what Jan was saying, because it's clear, and we saw it this morning, that the rate of activity in the housing market and the mortgage market as a whole is very strong. But you're right, and by the way, I think all the evidence we have is that the cuts we made in the official rate, have been broadly passed through. But what has happened is, and this reinforces Jan's point about high LTV mortgages and the risks, and unfortunately, I'm going to use a cricketing analogy at this point, you do get what's called a batting average effect. In other words, what's gone on is that there has been a withdrawal of what I would call the cheaper high LTV products from the market. And the batting average effect means that the average cost of a high LTV mortgage therefore goes up. Doesn't mean to say any individual lender has not necessarily passed through a cut. It means that on average, the cost of a high LTV mortgage has gone up because there's been a withdrawal of products which were at the lower cost end for, let's say, a 90% LTV mortgage bracket, and that does increase the average cost of a high LTV mortgage. It's entirely consistent with what Jan was saying. And it is, I'm afraid, entirely consistent with having gone through a period where obviously there was uncertainty around the pattern of house prices. Now, to date, we saw some initial dip in house prices, but that is, on the latest evidence, that has been more than recovered. Question mark, as I said earlier, final thing I'll say is, I think probably there is still some uncertainty as to whether that is an effect that has been particularly brought on by stamp duty or whether it will persist. Thanks.
Thank you. Right. There are reports that information that lenders are demanding, the information that they're demanding is like nothing that's been seen before. They're literally fine-tooth combing bank statements for anything that might be out of place. Are there checks for the purposes of FPC mortgage controls?
Well,
you look. Is that to Andrew? Great.
I didn't think I'd be able to say this for a long time. I think that's really more a question for the FCA, actually, because it's really a conduct question. The FPC's policy in the mortgage market is particularly directed at avoiding an over-concentration of borrowing with high loan to income ratios because of the historic relationship that tends to have both with actually the mortgage defaults, but also with downturns in the economy and a negative effect on consumption in the economy. So I think that really a question is more one about the conduct of mortgage lending, and is one for the FCA.
Okay. The FPC appears to be taking a stance where they would encourage lending. Are banks following this encouragement?
Well, I'll start. I'm sure other members of the FPC will want to come in. I mean, actually, interestingly, we have seen, particularly for corporates, we've seen very strong bank lending, historically strong bank lending. Now, you've got to break that down into various parts. So in the initial part of the COVID period, before the government schemes came in, we saw large corporates drawing heavily, particularly on their standby revolving credit facilities, which they have. And if you look at the numbers for February and March, particularly March, I mean, there was almost a record drawdown of corporate lines of credit.
I'm kind of more interested in the whole mortgage side of things.
Oh, the mortgage market. Well, I mean, obviously, the mortgage market essentially froze during, obviously, we went through a period where it just shut down. So there was almost no activity. I mean, we are now in a period where the mortgage market has returned very strongly. And I say on the latest data this morning, looking at mortgage approvals, and then when we look at the sort of the forward-looking indicators that we get from some of the commercial mortgage services, the online mortgage services, I mean, the pipeline of activity seems to be very strong. So at the moment, the mortgage market is one of the strongest, if not the strongest area of recovery.
Has the cut in stamp duty caused a mini boom in borrowing that lenders don't have the capacity to deal with?
I don't think, I think it's hard at the moment to judge the impact of stamp duty. We'll know that after the event, because as I say, the other complicating factor in this is to what extent there was just a pent-up demand in the pipeline that had got blocked back in March, April, that has now come through. So we won't know, I think, the answer to that question. I do not sense that, but obviously it's something that's of great interest to both us and the FCA, I should say, that there has been a relaxation of lending standards. I mean, going back to the point we were making earlier on high LTV, with Jan and I were making, the evidence on the tightening of terms for high LTV lending suggests actually that probably a bit the opposite actually.
I mean, we're hearing of first-time buyers hanging on the phone to get through when the banks or building societies open in an attempt to get a very restricted number of mortgage packages for them.
Yeah, I think I think that's right, because I think the number of people at the moment who are seeking mortgage approvals is probably at quite record levels, and not obviously record levels possibly absolutely, but also in relative to the capacity of the lenders to actually, to do the approvals. So, yeah, I think you're probably right, because what you just said is consistent with the rate of mortgage approvals, which is very high.
Okay, thank you very much.
Thank you very much, Yvonne. My apologies that I wasn't more nimble-footed when you lost your papers. I should have moved on.
No, that's okay. That's my fault.
Sorry for that. Entirely my fault. Can we move now to Steve, please? Thank you.
Thank you, Chair. And as always, I refer to my registered interest in GlintPay, and I also want to apologise for being late to the session. I've been in the House of Commons. Can I ask you first some follow-up questions, Governor, on your speech you've made recently? Because in talking about headroom and QE, there seems to be a suggestion now that you want to unwind QE first. And I wonder if that means that QE is now the bank's preferred tool, or I don't want to put words in your mouth, of course, but I wonder whether it's a necessary evil or the new normal to be adjusting reserves first before the interest rate. What is your view?
No, it's not. I have put the question on the table. And bear in mind that I was speaking that Jackson Hole was looking at the next decade. So there is an established policy for the MPC and the bank that a QE unwind program would not begin until rates had gone up to, I think, 1.5% is the number. And there's a great logic to that, but don't get me wrong, because what that essentially is saying is a high priority is to get into a position where, to your point actually, that there is more scope to move interest rates both ways. Because there's no question that would be a good thing for the MPC. There's a great logic to that. Now, the question I pose is something like the following. I'll give an observation for a moment. If you look at the interest rate curve at the moment, you don't get to 1.5% on the interest rate curve inside 10 years. So on current pricing, we would be in that position for up to a decade. Now, the question we pose is this. We've had two major shocks in the last just over a decade. We've had a global financial crisis and we've had COVID. Now, the work that we did in the paper that we published last Friday looked at the conditions under which QE may be more effective and to what extent QE is state contingent. So we went through the arguments, the channels that QE works through, looking at signalling, looking at portfolio reallocation, looking at liquidity. Tentatively, because there are obviously the number of case studies isn't enough to be tremendously scientific here. We think that there is a state contingent element there, that QE has a more powerful effect, or some of the channels of QE might work more powerfully in these conditions of stress and market liquidity. I don't think that's very surprising, but I think it's very interesting and very important because of what tools we use in particular situations. Now, the question then is, well, okay, obviously I'm not going to be making a prediction here, but we've had a very deep crisis, about once a decade in the last last 10 years or so, and they're very different, but they are things that we have to deal with. And we've used, I think, our toolkit, aggressively and actively and rightly. So the question is, what do we need to do as central banks to put ourselves in a position where we can use those tools most effectively? And does that call for what we call in the paper a counter-cyclical operation of the balance sheet, in which we do seek to reduce the size of the balance sheet in the periods of upturn? Because both monetary policy and financial stability policy are counter-cyclical policies, in effect. So should we be putting ourselves in a position where we are more able to use the balance sheet, do QE, in times of great need and great stress, when it appears to be highly effective? Now, we've put that as a question because it's, I'll bang our drum for it, it's pretty leading edge in terms of thinking, but it's very important. So that's, I hope that sort of gives you a picture of what lies behind the issue that we put on the table.
That is helpful, thank you. I want to pick up on a couple of things. So, you mentioned it could be sort of 10 years to get back to 1.5%. But, I dare say people on this call and many people watching can remember when they used to get interest worth having on their savings.
Yes.
What are we to say to savers? When are savers going to get back to having interest worth having on their saving? And what does that mean for a culture of thrift and saving and looking after oneself?
The challenge of that, and I'm sure colleagues will want to come in. Nan's had his hand up, I can see it.
I'll bring him in.
We're living in a world of globally, this is happening pretty much globally, of very low equilibrium interest rates. And the reasons for that are to do with quite deep structural changes in economies, for instance, aging of the population, greater savings. And those are having, I think, profound effects on the equilibrium interest rate. Now, 10 years ago, when low interest rates first emerged and dealing with the financial crisis, I think it was very reasonable to have, as the debate was at the time, to say, is this a cyclical phenomenon? Is it product of the depth of the recession, but it will go away, or is it more structural? I think today, much of the experience in the academic literature and the research done by central banks like the Bank of England suggests it is structural. Now, this might seem like a cancer of doom to your question, but it does mean that if we believe this, that we're going to have low equilibrium interest rates for a long period of time. I'll stop there because I'm sure.
I want to bring Dr. Vega in, but I do just want to push back on one point. When I look around at the culture we actually have in the country, looking at the streets, looking at the data, there isn't a lot of evidence that people are willing that people have a low price on postponed consumption, as it were. Actually, what people want to do is bring forward their consumption. There's an awful lot of, for example, big fast cars out there funded by cheap credit. Well, I'm all for enjoying oneself in life. I like big fast cars, but I just, you only got to look at the streets to see that people are buying cars on credit. Well, I mean, I don't mind sharing with the public. We recently, in my household, bought a car with cash. The garage hardly knew what to say to us when we said we wanted to buy a car for cash. Nobody does that anymore. They buy them on credit. Where's the evidence that there's any kind of culture in society of having a low value on postponed consumption? I just don't see it. I see people having a huge demand for debt, and it's cheap, and so they can have it.
Well, it's true, of course, that they probably didn't like you for turning out with cash because they make more money by lending you money than selling you a car.
But this is madness, isn't it? Madness.
But hang on, but look, let me be honest. I mean, this is the question that monetary policy can solve. The question that underpins monetary policy is the one I said before, which is, we are now living in a world of very low structural real interest rates. We're also living in a world of low inflation. I mean, the challenge we have, which was not the one I was closely involved in setting up the MPC in the mid-1990s. I mean, if you'd said to the people who were on the MPC originally, you know what? The challenge you're going to have is getting inflation up to target, not getting it to stay down at target. They'd have looked at you and said, really?
Can we bring in Dr. Vega? Would you mind? Because I've just realised I've only got 3 minutes left. And Dr. Vega.
So just first, I wanted to answer your first question very directly. QE is not the preferred tool. QE is, in most circumstances, the tool you use when you've exhausted your interest rate tool. I certainly don't think about that any differently, and I don't think the rest of the committee thinks about that any differently. Now, what's important about QE is, when you think about how well it works, is the power of QE is state contingent. That's a rather jargonish way of saying in certain circumstances it works very well, in certain circumstances it doesn't do very much. And one of the things that the governor highlighted is that some of those circumstances where it works very well is, for example, the circumstances that we faced earlier this year when there was substantial disruption in the government bond market, not just in the UK, but internationally, and that's when QE is particularly powerful. But in other circumstances, such as when markets are functioning well, but long-term rates are already very low, then I would have much lower expectations of what additional QE can achieve. And I think that's the key insight, is that there isn't some fixed multiplier from QE to the rest of the economy or to inflation. It depends on the circumstances. And the last thing I want to say is a really important part when you think about sequencing and do you unwind the QE first or do you raise rates first, is I've previously made this point, as long as markets are functioning reasonably well, you can probably unwind at least part of the balance sheet without affecting the economy very much. The key is that you want to avoid sending an inadvertent signal about what you're going to do with interest rates by unwinding the balance sheet. And so before we think about when we're going to do this and in what sequence we're going to do this, a key requirement is that we should be very clear about what we intend to do with interest rates, because sending an inadvertent signal is what causes a lot of disruption. That's what happened in 2013 in the US. So this brings back to being very clear about this.
I'm sorry to cut you off, but I have literally at that point run out of time. I'm very happy to hear you say that. I'm very interested in the economic theory of expectations and big players. And I think we're emerging onto common ground where we all understand that there can be a great deal of disruption. I would call it herding if things go wrong. But I'm so sorry we can't explore that. I have run out of time.
Thank you, Steve. Going to Mike, please.
Thank you, Chair. So my questions are around probing the EU decision not to assess UK equivalence in investment banking. And we note that the Financial Stability Report states that, to quote, the UK's equivalence assessment process is complete. So can we take it from this that the UK regulators have found the EU regulators and regulations as equivalent, and that this has been communicated to the EU? I don't know who can answer that.
I'll start, but I'm sure colleagues will want to come in. So it is true that we have done the assessment that we have to do on the leg of the whole thing, whereby we have to assess whether the EU is equivalent. The conclusion, by the way, actually is one for the government to make, not for us to make. So the question of when that decision is made and what it is actually one for the government. Now, can I come back to the first part of what you said, which is very important? Can I first of all say that contrary to some of the things that were said over the summer, the UK has submitted everything that was requested of it by the EU as part of the equivalence process. Some of the requests, came in a bit later than others, and so the deadlines were a bit movable at times. But everything has been sent in. You are right to say that Article 47, if I remember rightly, of MiFIR has been, for the moment at least, taken out of the equivalence process by the European Union. Now, this is important. Let me make 2 points around this. One, Article 47 of MiFIR is, as you said, essentially the investment banking service part of it. If you look across the landscape of equivalence, at where the value is in terms of equivalence, in terms of activity in financial markets, it's interesting. I'll use my words carefully here. That the largest amount of value is in Article 47 of MiFIR. Second thing to say is this: we understand that the European Union is looking at whether it wants to revise parts of MiFIR in the light of COVID, and this is discussed quite openly in some circles that there will be lessons from COVID which will cause it to look at some of the investment services provisions and regulations. I think that's very sensible, personally, for the reason that none of us would ever, I think, regard our regulatory rule books as fixed in all time, because, of course, the world changes. We learn things. Things change. We adapt to changes that go on around us. But here's the really important point. I just do not see how we can have an equivalence process that essentially says, the EU says, well, we're not actually going to even judge equivalence at the moment because our rules are going to change. Because what does that mean, really? It means really that they think that this is a rule-taking process whereby they will change up their rules, ring us up, tell them what they are, and then say, well, of course, if you want to be equivalent, you better adopt the changes to the rules that we've made. Well, I don't think that's not equivalence. Equivalence is about outcomes, it's about standards, it's a much broader judgment. And I'm very concerned that if that's how they think that equivalence works, we haven't made any progress in this debate at the moment. And we've said a lot about rule taking in the past and about the difficulty and the dangers of it, and now we seem to have some evidence that it may be taking effect.
I think that goes a long way to answering my second question, basically, which was because under Article 47, there's about 40 provisions, 9 of which the EU considering not looking at, and I was going to ask you why you thought that was the case. And I think you've just answered that, or started to answer that. Yeah, is there anybody else got an opinion on that?
Can I come in on that?
Yeah.
Just to reinforce what Andrew said, I think what it shows is the real danger for financial stability, actually, of having a kind of textual equivalence regime that can be withdrawn at any minute on the basis of a very precise reading of rule taking. We have a financial centre that's about 10 times the size of our economy. In other European countries, I think the biggest other centre is kind of 5, excluding kind of Luxembourg, it's about 5 times GDP. And so we need the highest standards of resilience in our financial system here. We only have to look back to the financial crisis to see how that 10 times GDP system could bring the economy to its knees. And the danger of an equivalence regime where you have to be precisely kind of textually equivalent is that you can't set the standards you need for your financial centre to protect your economy. And at the same time, you can't have the flexibility and proportionality in designing the rules to make them well tailored to your financial system. So you end up maybe with not enough resilience and with inefficient levels of resilience. And for all those reasons, the kind of precise textual version of equivalence is not great for either activity and competitiveness or actually financial stability.
This is fabulous because you've just answered my third question. This is amazing. And broadly speaking, the third question was, what are the financial stability consequences of there being no EU-side equivalence decision on Article 47 banking services? And you've just entered into that territory. Anybody else got anything to say on that subject? Will we lose stability? I think you've answered that.
I think the danger of a textured equivalence regime is that you can't necessarily keep up with a changing system and keep the rules well tailored to that system in the way that Andrew described at the beginning. And in that sense, it is a risk to stability. The flip side, of course, is that not that much business in London and the United Kingdom financial centre actually depends on equivalence. There's about £300 billion worth of revenue. About 30 billion of that comes from EU clients. Less than a third of that is at play when it comes to equivalence. So there's kind of trade-offs here between business going on and the financial stability risks, I think is pretty stark.
So what you're saying there is economic consequences for the UK of there being no EU-side equivalence decision on investment banking would be negligible? Is that
I think, as far as we can tell from talking to the firms we supervise now, yes, they would not be very large. Whereas these other issues we're talking about of financial stability risk and inefficient regulation of our financial system actually could be much bigger issues.
Yeah. Following on from that, if the EU is refusing to carry out some of its equivalence decisions, does the UK have any bargaining power within that, i.e. not finalising decisions, barring EU firms from selling services into the UK? Is that something that we would have in our armoury?
Well, perhaps I come back on that. I mean, obviously, as I said earlier, obviously it's a decision for the government, not for the Bank of England. I mean, I would stress, Alex is absolutely right in the way he's described the sort of the financial consequences, if you like, of this. However, I would say that, I think well-regulated, open markets are much the best outcome. So despite what we've said about, to what extent equivalence matters in a sort of financial sense, I'm still a strong supporter of equivalence because it means we have open markets that are well-regulated and that people can do business where they want to do business. And that will be better, actually, all round. So, this is still, something worth having, but it's not worth having on any terms.
Right. So going back to the politics, and because you've been excellent in anticipating all of my questions, the final one is the political one. So, in your opinion, Governor of the Bank of England, is choosing not to carry out these assessments not a breach of the political declaration accompanying the withdrawal agreement?
That's a really interesting question, which I don't think, as I said, because we're not, we're not conducting that part of the process. I'm not think we're really the best people to answer that question. But as I understand it, just to sort of put a little bit more on the point I made earlier, that the EU, because it has started a process to revise MiFID, therefore wants to delay the equivalence decision or process. And I think you make an interesting point about the text of the political agreement, which I'm really not placed to answer, to be honest, because we were not parties to it. But I would just reiterate the broader point that I think if that is the way the process is heading, then it suggests a very different view of equivalence to one that I personally think is the best way to do it.
Yeah, thank you for that. I think Colette, were you waving there? Dame Colette? Hello?
No, I wasn't waving, but if I had been waving, it would have been to agree with everything the Governor has just said.
Okay, thank you very much. Chair, that's the end of my questions. Thank you.
Great, thank you, Mike. And going now to Alison, please.
Thank you, Chair. I'd like to ask some questions around macro-prudential policy tools and whether they're fit to meet the challenges of economic recovery in a downturn. So to start first, some of the questions I have been slightly touched on before, but perhaps we could expand on some of those. Firstly, I'd like to ask about the 5 powers of direction at the FPC's disposal. Would it be fair to say that each tool is more about applying a brake to economic activity rather than accelerating activity?
Andrew, best on that. Who would you?
Well, I can start. I'm sure Alex and others will want to come in. I don't think we quite see it in those terms. I mean, of course, we're going through a very interesting, it's a real live example of this at the moment. I mean, the reason that let's take the cut in the counter-cyclical capital buffer that we made, and also the non-increasing it as we were intending to when COVID hit. It's about preserving lending in a severe downturn. It's not so much about accelerating lending or decelerating lending, it's about preserving lending and preserving the capacity of the banking system to support that activity. Now, so far, as Alex said earlier, I think, first of all, the reverse stress test that we did in the August Financial Stability Report, which was a very severe reverse stress test, and I wanted to say a bit more about it, indicates that the banks have the capacity to do that in very adverse situations. Secondly, as we were saying earlier, I think about when we were talking about the flow of lending, I'm encouraged by the fact that the banks are lending in the current environment. Lending flows are not really an issue at the moment, I would say, in the banking system. But I know Alex will.
Yeah, I'll add one thing to that, if I may, which is that lots of those tools, you implement them before the downturn, but they put you in a much better position to deal with the downturn. And Andrew's just talked about bank capital. I'll go back to the point I made earlier, which is that had we been now in the position we were with the banking system of 2007, the economic shock we've had means we would be in a full-blown banking crisis. We would not be talking about an expansion of credit to companies and families that need it to bridge through this. We'd be talking about a massive contraction of credit supply and how we can deal with that. The fact that we put in place the measures before this, through stress testing and the build-up of capital buffers, means that we're in a completely different position. Banks are now able to, as Andrew said, to draw down those capital buffers to absorb the losses that they will make because of this economic shock. And as a result, they can maintain the lending that they've done. They don't need to cut back and sort of adopt a defensive crouch like they did back in 2008. And that's been the essential foundation for everything else that's gone on, because the lending schemes, whether that's bounce back loans or business interruption loans, they would not have had much value if the banking system through which they're being channeled was actually on its knees, like it was 10 years ago. So the measures we've had, the macro-prudential measures we've had in place, have put us in a much better position to be able to, for the financial system, to support the economy, give it the support it needs through this. And it might look like they are brakes, to use the car analogy, which keeps coming up in this session. It might look like they are brakes that you apply in the run-up, but actually they put you in just a much better position during the shock. They give you the resilience that the system needs to be able to draw on to keep lending and keep supporting the rest of the economy. And I think so far, on that measure, the performance of the system has been a complete transformation from where it was about 15 years ago.
Okay, do you have evidence to sort of support that an increase in lending can be attributed to reducing the counter-cyclical buffer?
Yeah, I mean, we've heard from we talked to the banks obviously very directly, and their big concern before was that we'd made them build up these buffers of capital, but they wouldn't be able to draw them down as they took the losses. And so they'd need to take other defensive actions and cut back on lending. Actually, we've shown a willingness a couple of times now in the face of an economic shock or a prospective economic shock to release that buffer, which sends a very powerful signal to the banks that it's okay to run down your capital buffers. We are completely serene about that. That's why the capital's there. It's there to absorb losses so that they can carry on lending. And it's why in recent financial stability reports, our message to banks has been, look, you are going to take losses because of the economic shock here. Your capital will be drawn down. That's exactly what it's for. You don't need to go into defense. And as a result, they have been rolling over existing loans. They've been expanding credit supply, as Andrew said earlier, hugely in the early months and latterly through the government schemes in a way that no one could have envisaged in the last recession or even recessions before that. So I think the lending numbers speak for themselves in terms of the way the banking system has been transformed over the past 15 or so years.
I've got Andrew and then Dave actually have the hand up. Oh, and
just
as well. So let's go to Andrew first.
Well, just very, very quickly, I was just going to add one thing, that all of this has happened at a time when they have had to make additional provisions. They are having to provision quite aggressively on the financial reporting standards. So it's been critical for us that we've been able, notwithstanding the need for banks to increase their provisions against expected loan losses, to actually be able, as Alex said, to support the lending. And so far, it's worked.
And to Dave.
Yeah, I just wanted to make 2 points to reinforce what Alex was just saying. One, that we've stressed this, as well as stressing that banks can use their buffers, and that the buffers are there to be used for just this kind of situation. They've built up capital buffers so that overall capital is 3 times higher than it was in the run-up to the last crisis. But we've also emphasised that it's in their collective interest that they should all lend, rather than one individual bank thinking that it can sort of go down a different route, because that way that supports the overall macroeconomy and actually over time means that the credit losses that they make will be less, because the economic downturn will be ameliorated and the recovery will be stronger. And my second point is just to summarise what Alex has been stressing throughout, and Andrew throughout this hearing. What's really striking about this crisis and the recovery phase of it is that banks are part of the solution. They were the problem in the financial crisis. They exacerbated a real economic downturn, and they meant that the recovery was more prolonged, took longer to get back to close to where we started. This time round, banks are playing their part as part of the solution. And it's very important that we, through all our analytical exercises, the reverse stress tests and everything else, support them in doing that. But we do have to recognise that they don't have infinite capacity. Capital could be exhausted if you had shock after shock. But from where we are so far, we're very confident of the resilience of the system and that they can continue to be part of the solution.
Thank you. And Colette, I think you wanted to come in.
Yeah, very quickly, Chair. Really, my point was a version of what Dave's just said. This is about the system. What the FPC does is aim to ensure the financial stability of the system. So to go right back to the question, which was couched in terms of breaks, that's not really the right analogy. What we aim to do is ensure that the financial system can deliver for the real economy, and that's what our objective is.
Okay, thank you. Can I ask, can I pick up on Colette's point about equity finance that was made earlier on? Do you think there's a particular area where equity finance would be most useful? Is it about finance for highly leveraged companies, for new companies, for growth, balance sheets, or for all of those? Would you have a particular priority?
I'll kick off on that, Alison. As my colleagues know, I'm particularly interested in equity finance for small and medium-sized businesses. There is, as you will know, there are various issues in the supply of equity finance to those businesses, which I think we have to tackle. Why don't, for example, pension funds invest more in these longer-term, initially illiquid investments? What's stopping them? Is there a reason? Now, there may well be things that we have to understand and unpick to address that problem. But for what it's worth, I think the thing we have to focus on is the small and medium-sized businesses who find it extremely difficult to get into those sources of longer-term finance, that what people used to call patient finance, although they don't anymore.
Okay, does anybody else want to come in on that? I think I'm just about out of time.
Can I add just one quick point then, which is to go to your question about who needs it. I think there'll probably be three kind of sources of need for greater equity finance. And all of it, by the way, is probably in the unlisted, or largely in the unlisted sector. So this is people who don't have access to the public capital markets, which is great that they're open. That's why it's going to rely, as Colette says, on insurance companies, pension funds, investment funds of all sorts, and why in the Financial Stability Report we set out our initial thoughts on possible reforms in those areas that might increase the demand for equity. And the numbers involved, assets under management, 5.2 trillion in those things. So a small movement in the needle on the dial can actually make a big difference in terms of the supply of equity of unlisted types across the economy.
Okay, thank you very much.
Thanks, Alison. And finally to Anthony, please.
Thank you very much, Chair. And I should declare that, obviously, National Party record, I used to be Chief Executive of the British Bankers Association and worked on many of these issues with the FCA and the Bank of England. The questions I'm asking are, touched on a bit about the stability of the system and how the banks have responded to the crisis. And I just want to pick up on a couple of points. You mentioned earlier the banks went into this with 3 times the amount of capital that they had before the global financial crisis. Do you know what impact it's had on their capital ratio so far in this crisis? Is there any estimate of that? I don't know if this question is to Alex or Andrew.
Shall I? I'll start. Actually, reported capital ratios have risen by 0.5 percentage point. So for the major banks, actually, their common equity tier 1 ratio has risen from about 14.5% to around about 15%. That's actually because their underlying profits and, very importantly, the retention of dividend, what would have been a dividend distribution, has allowed them to boost their capital position. When we look at the possible losses they could take in the sorts of scenarios in the fan charts, in the central case, on prudent assumptions, you're looking at credit losses of the order of around about £60 billion. That's not far off, actually, what their market valuations are actually implying. So don't take our word for it. The market's looking at the same, which is a fall in capital ratios of around 2.5 points. So 15.5 down to around 13. Complete contrast with where we would have been back in 2007. Can't emphasize that enough. That drawdown of capital would have basically wiped out the capital of the banking system. So we're looking, in the central case at least, at a small use of capital buffers. It would take a doubling, really, of the severity of the scenario to use up, reasonable proportion of banks' available capital buffers, which is why, as Dave said a moment ago, we've been able to conclude that banks are actually resilient not just to the central case, but to a very wide range of potential economic outcomes embodied in that very wide fan chart that we started our discussion off with earlier on.
Absolutely. And you touched on the possible credit losses there and the provisioning made for them. Have you done estimates yourself of the possible credit losses for the industry? There's a huge amounts of lending. Some of it's guaranteed by government, obviously the bounce back loans, but the banks don't know quite how they're going to realise that guarantee. And then there's C-bills, which are only partially guaranteed by government. Yeah, so our estimates, back in May, we looked at an economic scenario that was actually overall a bit more severe than the latest central projection in the Monetary Policy Report. And on relatively prudent assumptions, we calculated overall credit losses, not just on the new loans, which are a very small fraction of banks' books, but on their existing books, of around about 80 billion. The fact that the central outlook is modestly better than it was back then means that we're in the ballpark on prudent assumptions, as I say, of around about 60 billion. They've already made provisions of around 20 in the first couple of quarters. Remains to be seen how that plays out. But even 60 billion is a small dent in banks' capital buffers that have been built up for this very reason. And then to come back to the discussion point earlier about the impact of leaving ending the transition period with the EU without a new deal, you implied that actually that was a fairly would have limited impact. That's well within the stability of the banks to withhold that. So you have no concern about the range of future shocks there could possibly be? No, as is well known, we looked at some particularly bad disruptive scenarios for the end of the Brexit transition period. I think our latest word on those was in a letter to your predecessor committee in September 2019. Those sorts of scenarios, pretty bad, lots of disruption,
as Andrew said earlier, you can't disrupt trade twice, so they're definitely a worst case in the current circumstance. And we were looking there at a shock that depleted across the system, as Colette said earlier, capital ratios of by around 1.5 points. And so well within the margins we're looking at here, hence why we were able to conclude in the financial stability report, not just that the system could deal with a much more severe period of economic disruption arising from the virus, but also on top of that with some disruption to trade and activity resulting from the end of the transition period as well.
Thank you. And just want to turn to the issue of competitiveness. This is obviously an old issue that you've been looking at, as a country, been looking at for 20 years or so, and the impact on the prudential regulation. The government has, the Treasury issued a policy statement update in June where they said they'd put more emphasis on international competitiveness in the financial services bill. Do you have particular concerns about that and what impact that might have on prudential regulation? I'm looking at Andrew here, who holds overall responsibility for this, bringing the parts together.
So I think we have to be very careful about how we sort of, in a sense, define the meaning of this. In the prudential world, of course, much of the framework that we operate under, particularly the micro-prudential framework, is actually defined by international standards, particularly by the Basel Committee. And it's very important that is the case. I mean, that is a crucial foundation, which has been reinforced, obviously, post-financial crisis by the work of the Financial Stability Board. And it is crucial that there is no, in a sense, element of what I might call competitiveness in anybody thinking they can sort of get ahead of another one in terms of the operation and the creation of those international standards. And one of the great strengths of the system post-financial crisis is that we've had a truly global response, and it hasn't led to an outbreak of competitiveness. Now, in the world, so in the prudential world, given that, I think it is always sensible to ask the question, what are the effects of that system? What are the effects of the way it operates in any particular jurisdiction? Is it having unexpected effects? I don't have any problem with that, and I don't have any problem with, carefully applying the word competitiveness in that respect. So I don't have difficulty with the way it's couched in those terms. But I do just want to emphasize that we have to have a robust underpinning of standards, which I believe we have achieved post-financial crisis. And that has been, as Alex was just saying very eloquently, that has been hugely to the benefit of the system in the crisis that we've been in.
One last question. We've covered a huge range of areas. I was just wondering, throughout this whole crisis we've been through, are there any particular lessons learned from the Bank of England's point of view?
Oh, I mean, yes. Indeed, going back to the questions that Mr. Baker was asking, I mean, the paper that we released on Friday was very much, and this is an area of the financial policy tools, was actually very much drawing on lessons of the crisis so far. I have to emphasise so far because wish we could say we were definitively on the other side of it, but I don't think we can. So, I mean, that's one. I think big lesson that Alex has mentioned, a big lesson in respect to the banking system. There's one other big area which probably time doesn't allow us to get much into, but again, we flagged it a number of times, and I flagged it on Friday. And here's the big area, the other big area of sort of work that we're doing, but we're doing this internationally. That in many ways, the threats to financial stability that we saw in March were in the non-bank parts of the system, not the banking parts of the system. And we've described that as so-called dash for cash. The speech that John Cunliffe gave, speech that Andrew Hauser, our executive director of markets, gave. We've been major proponents of the work that the Financial Stability Board is now doing on this because we think it does raise very big questions. And it raises questions both for financial stability and monetary policy. Financial stability in the sense that, yes, the post-crisis financial crisis reforms have led to, I think, a very sensible rebalancing of activity. So there's been a relative growth in the non-banking system versus the banking system. I don't think that's a great surprise factor given the experience of the crisis. But we have to ask the question, are there elements of the non-bank system and weaknesses in the non-bank system which could, in their own right, have systemic effects throughout the system? Did we see those during March, for instance? It is also true, and here's where monetary policy comes in, we had to, and other central banks, Federal Reserve, ECB, others, had to respond with very, as we were saying earlier, I use the term go big, go fast, very aggressive use of QE. Now, that was done also, as Jan was rightly saying, Jan described this as well, a state contingent point. It was done because of the economy, but it was also initially done because we were having a meltdown in certain parts of the non-banking financial system, and we had to respond. Now, big question we've got on our agenda, therefore, is because we had to not just use the traditional tools of central banking, which put liquidity into the banking system, we had to go beyond that and use QE, which can go to, to borrow the Heineken advert, parts that other beers can't reach. We of course, and other central banks have to ask the question: is that the optimal? Is that the optimal system and the optimal response? So these are very big questions.
And I think Alex will quickly and then
I just wanted to develop Andrew's point with one brief thing, which is the big thing we saw in the non-bank system, the dash for cash, as Andrew describes it in March, was a big threat to financial stability. Now, the cure, as Andrew says, go big, go fast asset purchases was very effective. But the big question we're addressing now with international colleagues, because these markets are international, is, well, what preventative measures, what prevention might actually be better than a repeated cure for the non-bank financial sector, where, frankly, we had a rise in gilt yields from 0.2% to 0.8% in a week. That is not financial stability. And it had nothing to do with gilt issuance. It had everything to do with the financial position of the people investing in those markets. So I think, internationally now, we're looking quite seriously at prevention that might remove the need for such aggressive cures in future.
By which you mean regulation of the non-bank sector?
And various measures, yeah. And those are detailed in, our ideas about those are detailed at some length in the Financial Stability Report, around margin requirements, around leveraged investors, around money market funds and open-ended funds. So it's quite a broad, canvas. But lots of the interesting thing that happened in markets in March was that lots of issues some of which we'd spotted, lots of issues and vulnerabilities in markets actually came together and kind of fed off each other to create this dash for cash that drove gilt yields and other bond yields up very sharply in a short period.
In a sense, it's inevitable that as you drove risk out of the banking sector, that risk ended up elsewhere. Dave, you were wanting to speak. And I think that's the last question, then run out of time.
And Alex has said much of what I was going to say about the ongoing agenda, but for non-bank finance. But we are left with the position where, as Andrew said in his Jackson Hole speech on Friday, we have the Bank of England's balance sheet is now at about 40% of GDP and rising, and we need to think through the implications of that, and whether prevention, as Alex has said, from the private sector wouldn't be some self-insurance alongside us playing that role. The only other thing I was going to say, the other lesson we've learned is, and I say this with responsibility for a lot of the bank's operational functions, and this takes us back to where we started this session, is that we've learned in the Bank of England that in a crisis we can run all our critical functions from away from the office, whether that's Threadneedle Street or our Moorgate offices. So all the interventions we've made, the creation of the CCFF, the QE, all the market activity to support the bank's interventions have all taken place from people's home offices. So that's not necessarily at all sustainable. That's not where we want the new normal to be. But it does suggest more flexibility in how we run our key operations, and that's true of us and other parts of the financial sector. We've managed to run the risk assessment alongside those, because obviously you have to be very mindful of operational and cyber risks. But again, that takes us back to where we started. But I just wanted to add that as a rather more prosaic lesson. Thanks.
It's quite an extraordinary thought that people have been basically spending tens of billions of pounds from their home offices. And as you say, that shouldn't be the new normal. That's all my questions. Thank you very much.
Great, thank you, Anthony. And we're out of time. That brings us to the end of this session. But could I thank all our panelists? As usual, when we are Bank of England facing in these sessions, we tend to have a very detailed, rich and insightful experience with you. And I think I speak for the whole committee by saying that we've had exactly that today. Governor, you were very good at anticipating the questions. Our hope as a committee is that you're all very good at anticipating the answers as we go forward. And we thank you for the very hard work that I know you're all doing to keep the economy going as best that we possibly can under these difficult circumstances. And on that note, this session is now concluded. Order, order.
Committee Room 6, sound. Committee Room 6, sound. Committee Room 6, sound.